Today, we will learn about irrecoverable debts and provision for irrecoverable debts. Let me take you through the definitions of three important key terms: irrecoverable debt, decrease in provision for irrecoverable debt, increase in provision for irrecoverable debts. Irrecoverable debt or bad debts. These are amounts owed by credit customers that will definitely not be received and are written off as an expense in the income statement. Decrease in provision for irrecoverable debts. When the estimated allowance for doubtful debts is reduced because fewer receivables are expected to be uncollectible, this reduction is recorded as income in the income statement. Increase in provision for irrecoverable debt. When the estimated allowance for doubtful debts is raised because more receivables are expected to be uncollectible. This increase is treated as expense in the income statement. These are the double entries for all these three criteria: irrecoverable debts, debit irrecoverable debts and credit trade receivables, decrease in provision for irrecoverable debt, debit provision for irrecoverable debt and credit income statement, increase in provision for irrecoverable debts, debit income statement and credit provision for irrecoverable debt. Let's look at a sample example for entries for irrecoverable debt. Rania owns a business and sells goods on credit to customers. At the start of the year 2022, trade receivables £12,000. At the same date, irrecoverable debts £200. On 31st of December, the amount owed by Nora, a credit customer, £50, was considered uncollectible. What is the normal balance of the following? Trade receivables, irrecoverable debts. Trade receivables has a debit balance since it's an asset. Irrecoverable debt has a debit balance because it's an expense. What happens to the trade receivable due to an increase of irrecoverable debt? In this case, trade receivables will decrease. Therefore, what should be the double entry? Debit irrecoverable debts and credit trade receivables. You'll need two ledgers, one for trade receivables, another one for irrecoverable debts. First, we enter the opening balance of trade receivables and irrecoverable debts both on the debit side. Now, in order to complete the double entry, you credit the trade receivables, debit irrecoverable debts account. Then we balance off the trade receivable account by carried down, brought down, irrecoverable debts balancing and transfer to income statement. Now let's see how we transfer these entries. Enter the opening balance of trade receivables, 2022 Jan 1st balance brought down 12,000. Debit the balance of irrecoverable debts on the debit side, 2022 Jan 1st balance brought down 200. Now let's post the double entry, debit irrecoverable debt account for the year end adjustment for irrecoverable debt, debit irrecoverable debt December 31st, sorry for the typo, opposite accounts name trade receivable and 50. And in the trade receivable account, you credit December 31st irrecoverable debt 50. Now let's balance off the trade receivable account. As you can see, debit side is greater, 12,000, bring it to the total. Take away 50 should give 11,950 as balance carried down. 2023 Jan 1st balance brought down 11,950. Now let's balance off the irrecoverable debt account. Debit side is greater, 250 and transfer to the income statement as at 2022 December 31st, income statement 250. Now this is how we complete the double entry for year-end irrecoverable debt. Now let's look into an example of an increase in provision for irrecoverable debt. This is a sample format. This isn't the answer for the question here. 2020 Jan 1st, provision for irrecoverable debt 600. Same date, trade receivables $10,000. Irrecoverable debts $500. On December 31st, write off 200 as bad debt. Provide 10% of the remaining debtors, provision for irrecoverable debt. Find the net trade receivable at 2020 December 31st. So you take the opening balance of trade receivable 10,000, year-end bad debts 200 or irrecoverable debt. Therefore, net trade receivable should be 9,800. Now, let's calculate the provision for irrecoverable debt for the year ended 2020 December 31st. Do take the balance of net trade receivable. Find 10% of it as it's mentioned in the question. Therefore, it's 980 for the current year's provision for irrecoverable debt. Is there an increase or decrease in provision for irrecoverable debt at December 31st, 2020? At the beginning, it was 600. Now, it is 980. So basically, it has increased by 380. 980 is the closing. 600 is the opening of provision for irrecoverable debt. As we can see here, it has increased by 380. Now, let's see how to post these entries to a ledger. Can you take few minutes looking at this format, try completing the provision for irrecoverable debts in your own so that we can check the answers in the next slide. Now let's see how to post these entries for provision for irrecoverable debt account. We are preparing this for the year 2020. Let's enter the opening balance. Jan 1st, provision for irrecoverable debt 600 on the credit side. Why we are entering it on the credit side? Because provisions usually have a credit opening balance. Current year, it's 980. So you write it December 31st on the debit side as balance carried down 980. 2021 Jan 1st balance brought down 980 on the credit side. Now bringing in the total, debit side is greater. Bring it to the total, take away the lesser number side, which should be 380. This should be transferred to income statement as at December 31st. Now, let's look at an example of decrease in provision for irrecoverable debt. At the start of the year 2020 Jan 1st, provision for irrecoverable debt 1,500. At the same date, trade receivables 12,000, irrecoverable debts 400. December 31st, write off 300 as bad debt. Provide 10% provision for irrecoverable debt of the remaining trade receivables. Step 1 is to find the net trade receivables. Take the opening balance of trade receivables 12,000. Take away the bad debt of the current year at the end 300. Therefore, it's 11,700. Now, let's calculate the provision for irrecoverable debt for the year ended 2020 December 31st. 11,700 is the net trade receivable. Find 10% of it as the question demands for 10% provision for irrecoverable debt. Therefore, it should be 1,170. Is there an increase or decrease in provision for irrecoverable debt at December 31st, 2020? At the beginning, it was 1,500 and now it's 1,170. This indicates that there is a decrease of 330. Now, let's show this impact in the ledger. As we did before, the opening balance should appear on the credit side. Jan 1st balance brought down 1,500. For the current year, it's 1,170. December 31st balance carried down on the debit side, and then bring it to the opposite side on the credit side. 2021 Jan 1st balance brought down 1170. As you can see here, credit side is greater, bring it to the total, and the difference appears on the debit side. December 31st income statement 330. Since the difference is on the debit side of the provision for irrecoverable debt account, this goes to other income. Now, let's look at some exam style questions. Edexcel IGCSE Accounting Paper 1. During the year 30th June 2024, Sunal purchased additional machinery 5,000 on credit from AC Engineering. Irrecoverable debt 650 were written off. Prepare the journal entries to record the two transactions. Narratives are required. As you can see here, machinery is purchased on credit from AC Engineering. Machinery comes in, therefore machinery debit. You bought it from AC Engineering, therefore AC Engineering credit. And the narration is the summary of the transaction, being the purchase of machinery on credit. Irrecoverable debt 650 were written off. The double entry should be irrecoverable debt debit 650, trade receivables credit 650, being irrecoverable debts written off on this date. This was a 6 marks were awarded for this question. Remember, if narratives are being asked to be given, please do mention the narratives. This is a theory question for 5 marks. This will involve suggesting a solution decision by reviewing information from a scenario and providing a justification, exemplification for that choice. Archie also maintains a trade receivable control account. He suspects that not all customers will pay the full amount of the debts. He is considering 2 options, and the first option is to write off a percentage of the trade receivable as irrecoverable debt, or option 2, to make a provision for irrecoverable debt. The question is to discuss with reference to an accounting concept which action he should take. Your answer structure should be state the point. This is because relate to the accounting concept, as a result, and then the final decision. Archie should choose option 1 or 2 in order to continue your answer. These are the 2 sample answers given in the marking key. If you opted to consider option 1, then this should be the answer. An irrecoverable debt is an amount where there is a certainty that the amount will not be paid. Writing off an irrecoverable debt will result in not overstating the profit for the year and not overstating the trade receivables, thus complying with prudence concept. Therefore, Archie should choose option 1 in order to prepare accurate and fair financial statements. As you can see here, 5 marks are awarded for this sample answer. Let's look at another answer where it's the option 2 is being considered. A provision for irrecoverable debt is most appropriate where there is a degree of uncertainty whether or not the debt will be paid. Making a provision for irrecoverable debt will result in not overstating the profit for the year and not overstating the trade receivables, thus complying with prudence concept. Therefore, Archie should consider or choose option 2 in order to prepare accurate and fair financial statements. Any one of these answers can be a model answer for this question. State the book of original entry used to record each transaction. So I've taken only the one which is relevant to today's topic. Write off an irrecoverable debt. The book of original entry should be the journal. Explain one difference between irrecoverable debt and a provision for irrecoverable debt. 2 marks. The answer should be: an irrecoverable debt is a specific amount owing to a business which will not be paid, whereas a provision for irrecoverable debt is an estimate of the amount which a business may lose due to irrecoverable debt. Exci provided the following information at 1st May 2022. Trade receivables 18,600, provision for irrecoverable debt 744. Calculate the rate of provision for irrecoverable debt. In order to calculate provision for irrecoverable debt, we take the net trade receivable and find the percentage. So I'm just marking letter A in order to find the percentage because we are expected to calculate the rate of provision for irrecoverable debt. We have the provision, which is 744. Trade receivable 18,600. A is the rate we do not know. Divide by 100. So how do we work out the answer? Now find the subject. Therefore, it should be 4%. 18,600 into A over 100 equals 744. So 744 divided by 18,600 times 100 should give 4%. On 30th April 2023, trade receivables were 20,500 and irrecoverable debt of 750 was to be written off. Calculate at 30th April 2023 trade receivables. So basically you have to find the net trade receivables, which should be 21,500 take away 750. Now calculate the provision for irrecoverable debt. As you can remember, in the previous question, this is a continuation of this question, we had found that the rate of provision for irrecoverable debt is 4%. Same applies over here. We figured out the net trade receivable 20,750. Therefore, find 4% of it, which should be 830. Now, we are expected to prepare the provision for irrecoverable debt account. Remember to carefully identify the start of the financial year and the end of the financial year. The reason being that you should have the correct dates for each transaction for you to get 1 mark. So your financial year starts on 1st May 2022. Count 12 months in order to find the end of the financial year. If you count from May, June, July, August, September, October, November, December, up to there it's 8 months till 2022. Then January, February, March, April for the 12th month, therefore 30th April 2023. Now we have the opening balance of provision for irrecoverable debts 744. We have the closing, which is 830. Remember, provision has an opening balance on the credit side. Therefore, we enter it on the credit side 2022 May 1st balance brought down 744. Now, let's enter the closing, which should be carried down on the debit and brought down on the credit. 2023 April 30th balance carried down 830. 2023 May 1st balance brought down 830. As you can see, the debit side is greater. Bring it to the total. Therefore, the difference appears on the credit side. April 30th, 2023, income statement 86. Therefore, it goes under expenses in the income statement. Scenario, accounting concept. A customer's debt is written off as irrecoverable. Which accounting concept is this linked to? Can be accruals or prudence concept. Linked to prudence. As you can see here, the accountants write off the debt immediately as an expense. This ensures that the loss is recognized straight away. The receivables figure is reduced to show a true and fair view of what the business actually expects to collect. State the financial statement each would appear. Irrecoverable debt written off should appear in the income statement, whereas the balance on the provision for irrecoverable debt account in the statement of financial position. There's some MCQ. Identify the book of original entry in which irrecoverable debts are recorded. We did a similar question to this before. The answer should be journal. Always remember to use X while identifying the answers for a multiple choice question. State one accounting concept applied when making a provision for irrecoverable debt. As you can see here, it can be prudence, accruals, or matching concept. Prudence concept: irrecoverable debts are treated as an expense immediately when identified. This prevents overstating the assets, which is the trade receivables and profits. So writing off debts applies prudence because the loss is recognized straight away even before cash is received or confirmed. Accruals concept: expenses must be recorded in the period in which they occur, not when they are paid. Irrecoverable debts relate to the period in which the credit sale was made, so the expense is recorded in the same accounting period. Writing off a bad debt ensures that the cost of the sale is matched to the correct accounting year. Matching concept: the matching principle says revenue should be matched with expenses incurred to generate it. The original sale generated revenue. The irrecoverable debt is the cost associated with that revenue. Therefore, writing off the bad debt ensures revenue and its related expenses are matched in the same period, given a fairer profit figure. They didn't ask you to explain in this question, but I'm giving you the idea of why one of these should be the answers for this question. The answer should be either prudence, accruals, or matching. State the difference between irrecoverable debt and provision for irrecoverable debt. Again, we did a similar question. This was a repeated question in the past paper. Identify, indicating with a tick, in which section of financial statement each would appear. Decrease in provision for irrecoverable debt, and then balance of provision for irrecoverable debt. When there is a decrease, it goes in income statement income. If it's an increase in the expense, and the balance of provision for irrecoverable debt is adjusted in the current assets by deducting it from trade receivables. Look at this question. A trader provides a provision for irrecoverable debt of 5% of trade receivables. On 1st April 2021, the balance of the provision for irrecoverable debt account was $950. On 30th March 2022, trade receivables were $24,200, including an irrecoverable debt of $460. That was to be written off. Prepare the provision for irrecoverable debt account for the year ended 31st March 2022. Balance the account on this date and bring the balance down on April 1st, 2022. Take few minutes to see if you can complete this question. As you can see here, enter the opening balance first, which is $950, the opening provision for irrecoverable debt. Calculate the net trade receivable. $24,200 take away $460 should give $23,740. Calculate 5%, which should be $1,187. Enter the opening balance of the provision for irrecoverable debt $950 on the credit side as at 2021 April 1st. Carried down, brought down the closing year 1187, debited and credited. Bring the totals, and the difference is on the credit side. 2022 March 31st income statement. Again, be mindful with choosing the beginning and the ending of the financial year. Shahid maintains a provision for irrecoverable debt of 4% of trade receivables. The balance of the provision at 1st April 2023 was 1205. At 31st March 2024, the balance of the trade receivable ledger control account was 28,750. This includes a debt of 450 due to a credit customer that was irrecoverable. Prepare the journal entry to write off the debt. A narrative is not required. In this case, you don't have to write a narrative. Therefore, the double entry for irrecoverable debt should be irrecoverable debt debit and trade receivables credit. And part B is to calculate the change in the provision for irrecoverable debt. It's similar to the rate that we calculated before. Now let's calculate the change in the provision for irrecoverable debt 31st March 2024, stating clearly whether the change is an increase or decrease in the provision. As you can see here, the trade receivable is 28,750 and irrecoverable debt or bad debt is 450. Therefore, the net trade receivable should be 28,300. Calculate 4% of that as provision for irrecoverable debt, which should be 1,132. At the beginning of the year, you had 1205. Now you have 1132. So in that case, so let's figure out the answer. So at the beginning of the year, you have 1,205 and now it's 1,132. Therefore, there is a decrease. Let's calculate the decrease. So it should be 1205 take away 1132 should give 73, which is a decrease. Now these are some of the examples of exam style questions. So you have understood in today's lesson what is irrecoverable debt, provision for irrecoverable debt, increase and decrease in provision for irrecoverable debt, and we had completed few exam style questions.